School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment. Presenting Block 1 Introduction to Business Environment, Unit 1 Introduction to Business and Environment, Part 3. Learners, in Part 2, we learnt about types of business environment, importance of business environment, environmental analysis. Learners, in Part 3, we will discuss about basics of macroeconomics. Let's listen to Part 3.
Basics of macroeconomics. Since business is an economic activity, a business firm, an economic unit, and business decision-making, an economic process, it is the economic environment of business which is the primary consideration in evaluating the business policies, business strategies, and business tactics of a corporate entity in any national economy. Economic transactions are the lifeline of the business, and in the preceding sections, we learned how the business environment is influenced by the economic policies and economic structure prevailing in the country. So, students of business environment must have some understanding of the working of an economy. What are different sectors of the economy? How they interact with one another? How monetary and fiscal policies influence the economy, and so on. In the following sections, we shall study about the basics of macroeconomics. Macroeconomics is primarily the study of the behavior and performance of the economy as a whole. The macroeconomic theories make use of macroeconomic models to explain and establish the relationship among different macroeconomic variables. Income determination, price level determination, investment, employment, product, and money market equilibrium, exchange rate, the balance of payments, etc. are the main areas of macroeconomic theories. Macroeconomics also analyzes the working and effects of major government policies like monetary and fiscal policies on the economy. According to J.M. Culbertson, macroeconomic theory is the theory of income, employment, price, and money. According to Paul Samuelson, macroeconomics is the study of the behavior of the economy as a whole. It examines the overall level of a nation's output, employment, prices, and foreign trade. Interaction of business and macroeconomics. You must be wondering that we are students of management. Then why should we worry about economics and especially macroeconomics? What is the relationship between the two? On the contrary, the understanding of macroeconomics in particular is of immense importance for the students of management. Let us understand this interaction with the help of an example. Inflation is one of the prominent problems of macroeconomics. Inflation refers to the situation in which prices of goods and services rises continuously over a period of time. Inflation can affect both the consumer and producer depending upon the cause of inflation, whether it is demand pull or cost push. If it is demand pull or due to an increase in demand in relation to supply, then consumers are at a disadvantage. Cost pull or increase in the cost of production, for example, increase in input cost, affects the supplier or producer. To elevate the problem, the central bank of the country takes the help of the monetary policy. One of the instruments of the monetary policy is increasing the repo rates, that is, repo and reverse repo rate. This increase in repo rates leads to both increases in the cost of borrowing for business and a shortage of money supply in the system. These both affect the scale of production. So producers and enterprises keep a close eye on every move of the government concerning any change in monetary policy and other policies. Some important concepts of macroeconomics. Let us understand some of the major concepts used in macroeconomics. Net National Product or NNP at factor cost is commonly known as national income. The gross national product or NNP can also be evaluated at factor cost. The basic cause of difference between the two concepts is that NNP arises because of the allocations of market value do not go into the payments to the factors of production. Gross Domestic Product or GDP. GDP is defined as the value of final goods and services produced within the borders of a country during a fiscal year. It also includes income earned locally by foreigners and excludes income received by the nationals from abroad. GDP is calculated at two prices: market prices, that is, current prices, and constant prices. GDP at market prices. GDP at market price is the total value of final goods and services produced within a year at current prices. GDP at constant prices. GDP at constant prices estimates GDP in reference to some base period. For example, if we estimate GDP for 2020 and 2021, then it will give us GDP market price for the fiscal year 2020 to 2021. If we estimate GDP with reference to some base year, say 2004 and 2005, then it is GDP at constant prices or real GDP. The distinction between current and constant prices is important as GDP at current prices could grow very rapidly if prices are rising. This increase will not tell anything about the volume of production, whether the total output is increasing or not. On the other hand, growth in GDP at constant prices indicates a rise in the total production or output of the country. To obtain GDP at a constant price, GDP at market price is divided by GDP deflator and multiplied by 100. GDP at constant prices is called real GDP. While calculating GDP at a constant price, the base period is always mentioned. Aggregate demand and aggregate supply. First, aggregate demand. Aggregate demand is one of the most important concepts in macroeconomics. In simple words, it means total demand for consumer and capital goods at a given price. The formula for which is AD is equal to C plus I plus G plus within bracket X minus M. C stands for consumption, I stands for investment, G stands for government expenditure, X stands for exports, and M stands for imports. This equation encapsulates the gist of aggregate demand. In the two-sector model, there is an absence of G and within bracket X minus M. So the above equation becomes AD is equal to C plus 1 and investment is assumed to be constant. Ultimately, aggregate demand function is largely dependent upon consumption expenditure or consumption function. Second, aggregate supply. The aggregate supply shows the amount of output firms plan to supply at different levels of prices or the total supply of goods and services in an economy. Since firms like to sell more output with increasing product prices, the AS has an upward sloping supply curve. The intersection of AD and AS determines the short-run equilibrium in the economy. Multiplier or investment multiplier. Investment multiplier is of much importance in macroeconomics. It is a ratio of change in economic or national income to change in investment. The formula for which is M is equal to delta Y upon delta I. M stands for investment multiplier, delta Y stands for change in national income, and delta I stands for change in investment. Multiplier indicates that with 1 unit change in investment, how much national income will change. So, it indicates the level of investment required to achieve the desired level of national income. For example, if the value of M is equal to 2 and investment is increased by rupees 100 crore, then with this increase in investment level, the national income will increase by rupees 200 crore. The 4 macroeconomic sectors. The 4 macroeconomic sectors. Macroeconomics has primarily 4 sectors, and the interplay and the interaction of these sectors give momentum to the economy. First, household sector. This sector covers all the individuals in the economy. The major function of this sector is to supply the factors of production to the different sectors. There are 4 factors of production, that is land, labor, capital, and entrepreneur. The household sector is the ultimate consumer who consumes the goods and services that are manufactured by the firms and in turn make payments to the firms. This sector also provides the savings and supply finance to the firms. Second, firms. This sector comprises all the businesses, firms, and corporations. The major function of this sector is to manufacture goods and supply services for sale in the economy. They hire the factors of production and pay them factor payments, namely rent, wages, interest, and profits. Third, government sector. This sector involves the center, state, and local governments of a country. The major function of this sector is the management and regulation of the economy. It is mostly done by its monetary and fiscal policy. Monetary policy is related to the regulation of the money supply in the economy. Fiscal policy is related to taxes, public expenditure, and public debt. Tax and non-tax sources are the major sources of revenue, and revenue collected is spent on public health, services, infrastructure, etc. Fourth, the foreign sector. This sector takes into account all the economic transactions with the rest of the world. The foreign sector primarily consists of export and imports of goods and services. When we sell domestically produced goods and services to other economies, these are called exports. Imports are items that the domestic country purchases from the outside world. Net exports are exports minus imports. The 3 markets. There are 3 major markets in an economy. These are: first, goods market; second, factor market; and third, financial market or money market. Goods market. In this market, goods and services are exchanged among different sectors. The goods and services produced by the firms or industry are consumed by the households, the government, and the external sector. Factor market. The factors of production are traded in this market. The factor services are demanded by the firms for the production of goods and services, and these factors are paid in the form of rent, wages, and profits. For example, labor is a factor of production and is owned by the household sector, that is the workers. Workers offer their services and they are hired by firms, the government, and the foreign sector. In turn, for labor services, workers receive wages. This equilibrium of demand for labor and supply of labor is part of the factor market. Similar is the case for other factors of production. Money market. In this market, equilibrium is attained between demand for and supply of money. Primarily, money is provided in the form of savings by the household sector and is channelized by financial institutions like banks. Firms borrow from these financial institutions and equilibrium is attained in the money market. The government regulates the money market by its monetary policy. Circular flow of income and expenditure. The economic system can be viewed as the continuous flow of income and expenditure. It is this flow that determines the size of the national income and the overall worth of the economy. One of the major objectives of macroeconomics is income determination. So, it is important to understand the circular flow of income and expenditure. This flow can be understood with the interaction of 2 sectors, 3 sectors, and 4 sectors. First, 2-sector flow. In the 2-sector flow, we have 2 sectors, namely households and firms. We have discussed the main characteristics of both these sectors in the previous paragraphs. Household supplies factors of production, viz. Land, labor, capital, and entrepreneurs to the firms. Firms in turn make factor payments, rent, wages, interest, and profits to the households. The flow from households to firms represent the real flow. However, the flow from firms to households is money flow, as all payments are made in monetary form. The money flow from firms to households ultimately becomes the total income, that is Y, of the households. Similarly, there is a flow of goods and services from firms to households. In turn, for goods and services, households make payments to the firms, which is again money flow. This continuous real and money flow gives momentum to the economy. Financial intermediaries like banks channelize the savings from the households to the firms. The firms take the loans from the banks and other financial institutions. The primary ingredient of loan creation by banks is the savings from households. Households save their savings in the banks and then banks lend to firms. In the circular flows of income and expenditure, there are certain leakages or withdrawals and injections or additions. For example, savings by the households represent leakages from the system. Saving is that part of income that is not consumed. The amount of saving and the size of the circular flow are inversely related. More the savings, less will be the size of circular flow and vice versa. On the other hand, additional spending by households from past savings or borrowings acts as an injection or addition to the circular flow. More the spending, bigger the size of circular flow. Second, 3-sector model. In the 3-sector model, apart from the above mentioned model, one more sector, that is government sector, enters into the circular flow. Government affects the circular flow of income and expenditure through monetary and fiscal policy. In our model, we will only consider the fiscal policy effect, that is, taxation and government expenditure. Taxes, both direct and indirect, paid by both households and firms, act as a withdrawal from the flow just like savings. Taxes reduce the disposable income of both households and firms, which leads to a reduction in consumption and savings. On the other hand, government expenditure is like injection to the circular flow. Government expenditure gives more income into the hand of households that leads to an increase in consumption expenditure. Similarly, purchases of goods and services by the government from firms increase the income of the firms. Households also provide factors of production to the government and in turn receive factor payments. Third, four-sector model. Let us now learn about the four-sector model of the economy. This model includes households, firms, government, and the foreign sector. The four-sector economy has exports as inflows or injections in the national income, whereas the imports are treated as leakages or outflows from national income. Let us now briefly discuss the export function and import function. First, export function. The economic growth, economic development, and equitable distribution of income depend upon the export levels of a country. Exports are needed for maintaining foreign exchange reserves in an economy. Exports also play an important role in increasing the internal trade and economic stability of a country. The exports of a country depend upon several factors. Some are listed as follows. First, the prices of domestic goods in comparison to prices of similar goods in importing countries. Second, trade policy and tariff policies of importing country. Third, export subsidies. Fourth, income elasticity for import goods in importing countries. Fifth, level of imports by the domestic country. Thus, while computing national income, exports is taken as an autonomous variable and represented by X. Second, import function. Imports represented by M play an equally important role in the growth of an economy. Imports help strengthen the global presence of a country. The imports of a country depends upon the following factors. First, import prices in relation to domestic prices. Second, domestic tariffs. Third, domestic trade policy. Fourth, income elasticity of imports. Fifth, income levels. Sixth, export levels. When the value of exports is more than the value of imports, we call it trade surplus. However, when the value of imports is more than the value of exports, it is called a trade deficit and represents an unfavorable situation for an economy. Let us assume that households only supply labor to the foreign sector and in return they receive foreign remittances. Firms make payments for imports to the foreign sector and firms receive exports receipts. The foreign sector provides different taxes and tariffs to the government, and the government in return formulates various schemes and policies which facilitates trade. If the trade balance is positive, then circular flow increases as it increases the magnitudes of circular flows of income and expenditure. Summary. The environment is a complex phenomena. The term environment consists of several subsets, that is, economic environment, socio-cultural environment, political legal environment, technological environment, etc. It thus represents the totality of all kinds of environments which have an impact on business. To a large extent, the environment is external to the firm. Business firms in general have little influence on external forces. Depending upon the nature and composition of several subsets of the environments, the business environment varies from country to country and may even vary in the same country from one point of time to another. A number of problems are involved in the identification, description, explanation, and prediction of environmental factors. The environmental factors are dynamic. It is difficult to conceptualize and or quantify the proportion of change as well as the direction of change in environmental factors. Since the environment and the economic institutional framework affect business organizations, it is imperative on the part of the management to scan the environment before taking any decisions. The success of any business enterprise in a large measure would depend upon the proper understanding of the business environment. Microeconomics studies concepts like national income, nationwide employment, aggregate demand, aggregate supply, etc. It deals with the aggregates of all quantities as opposed to microeconomics, which deals with individual quantities. There are 4 microeconomic sectors, that is, the household sector, firm sector, government sector, and foreign sector. The concept of aggregate demand and aggregate supply is the total supply of the entire economy. Further, the concept of investment multiplier is of much importance to analyze the effect of investment on the national income.
You are listening to audiobook by School of Management Studies IGNOU for MBA program. Course code MMPC 003 Business Environment, Unit 1, Part 3. Course Coordinator Professor Neeti Agrawal from School of Management Studies IGNOU. Voiceover by Santosh Bharati. Edited by Tarannum Jahan. Program assisted by Jagbandhu Jana. And program produced by Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.